It's time for a quick review of RBI's monetary policy for August 2026. Will the repo rate continue to remain unchanged this month too? Hello, I'm Sameer Sawant, and today I will take you through the key takeaways. Whether you are an investor keeping an eye on debt securities or an individual just generally curious about finance, this review is a must watch for you. Let's get started with repo rate and stance. To begin with, the major key takeaway is that RBI has extended its pause, and any revision in the rate will be data dependent. This means that the repo rate remains unchanged at 5.25%. Thus, SDF rate and MSF rate too remain same at 5% and 5.5% respectively. The Monetary Policy Committee prefers to await greater clarity on the course of inflation and its composition before committing to any revision. Why this is continued pause, you might ask. Headline CPI inflation edged above the target broadly as expected, even as the realized Q1 FY27 print came in marginally lower than RBI's own expectation. This roughly translates to the fact that cost pressures are still some time from easing completely. So what's new in this month's GDP growth outlook? RBI's growth projection stands at 6.7%, which is only a marginal upward revision from 6.6% projected in June's policy. The key growth driver continued to be resilient private consumption, steady investment activity, and a stabilizing external demand. However, downside risks to arise, mainly from a renewed escalation of the West Asian crisis since the beginning of July. There are also volatile energy prices and uneven southwest monsoon amid a general El Nino condition that can bear heavily on agricultural and rural demand. Considering these factors, real growth is estimated at 7%, 6.4%, 6.5%, and 6.8% for Q1 and the subsequent quarters respectively. For Q1 FY28, a growth of 7.3% is expected. Now, let's have a glimpse at the inflation outlook. Headline CPI inflation rose to 4.4% in June 2026, which crossed the target for first time after 16 consecutive months below it. This surge was driven mainly by higher food and fuel prices, including pass-through into categories such as restaurant services. Core inflation, excluding food and fuel, held steady at 3.9% over May-June, while core inflation excluding precious metal was even lower at 2.3 to 2.5% over the same period, pointing to the still contained underlying demand pressures. CPI inflation for FY27 is projected at 5%, with Q2 at 4.7, Q3 at 5.9, Q4 at 5.5. Inflation for Q1 FY28 is projected at 5.3%, with risk evenly balanced. Core inflation for FY27 is projected at 4.3%. All in all, demand pressures are expected to linger in coming months. And finally, let's see how currency and foreign flows are faring. India's position has remained steady even through a volatile scenario. The current account recorded a surplus of USD 2.8 billion in April-May, led by healthy services trade surplus and strong remittance receipts. System liquidity averaged a daily of surplus 1 lakh crore since June meeting, with the weighted average call rate trading within policy corridor at an average of 5.31%. GSEC yields eased due to measures to attract foreign capital reaching fruition, though credit market transmission moderated with some hardening in deposit and lending rates. Credit growth remained robust and broad-based across sectors. So what's our view? RBI's decision to hold rate while retaining a neutral stance affirm our view that central bank will remain data dependent rather than pre-committing to a rate path in either direction. Headline inflation is still expected to rise in Q3, largely due to supply-side factors rather than any broad-based demand pressures. We believe that any chances of immediate rate hikes have been abated. That said, given the fluid geopolitical and monsoon-related risk flagged by MPC, we believe RBI will stay watchful and a rate hike cannot be entirely ruled out should inflation surprise meaningfully on the upside through H2 FY27. For now, rate stability should continue to support NIM visibility across banks, NBFCs, and other rate-sensitive sectors like housing, infra, etc. If you found this breakdown useful, don't forget to like, share, and subscribe for more sharp market insights. Also, feel free to share your thoughts in the comment section. Don't forget to join our Research Center WhatsApp channel for latest calls and in-depth reports across sectors and stocks. The link is in the description below. Thank you and happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.